Don't pay capital gains taxes. Hello, everyone. Troy Thompson the Angel of Freedom here. And today I'm talking about capital gains taxes. And of course, I'm being a little tongue-in-cheek here, and pay your taxes that are legally due. What I'm going to talk about today, though, are some ideas of deferring, reducing, and eliminating capital gains taxes. And so this time, the beginning of October, is a great time to have this conversation because many of these things need to be implemented by December 31st of the year that the capital gain occurs in order to take advantage of deferring, reducing, and eliminating the tax. First, I think it'd be best to give a brief explanation of what's considered a capital gain. So keeping it simple, I purchase an asset, let's say a stock or a house, and the value of that goes up, and then I sell it. All right, so I made a gain on that asset. Now, this would be not my personal residence. And so the difference between what I sold it at and what I bought it at is the gain, and then I have taxes to pay on that gain. For most people, that's going to be 15 to 20%. It's going to depend on their tax bracket. And so this is what where I will mention seek professional tax advice. I am not a licensed tax professional, so validate the words that I say and speak with your tax professional to make sure what I'm saying is accurate and how it applies to your personal financial situation. So I hold the asset. If I hold it for more than a year, then it's taxed at long-term capital gains rates, which are typically 15 to 20%. If I have it for less than a year, it's taxed as ordinary income. So a quick example of that would be people who are, say, a house flipper, and they flip the house within less than a year, well, then they could potentially pay a higher tax rate. So my video is about some ways to defer, reduce, and eliminate the capital gains. So in real estate investors are aware of this portion of the tax code known as Section 1031. And what it allows them to do is take the money that they receive from selling their rental property, let's say, and take that money and put it into another investment property. And when they do that, then they can defer paying the tax, meaning they don't have to pay the tax today. And that can be a very powerful tool to building their wealth and accumulating their real estate portfolio. Unfortunately, that's what most people know, or that's all that most people know is the 1031. So I'm going to offer a few other ideas today and talking just in general terms because it's going to depend on a person's overall financial situation, whether they are eligible to do certain things and whether it makes sense for them. And so keeping it kind of in general terms, first I'll talk briefly about the 1031 exchange, that it's very restrictive, so it can be very powerful, but it's very restrictive. There are certain timelines that have to be met. A third-party intermediary who handles those types of transactions has to be involved. So I can't personally take receipt of the money. The money has to go from the title escrow company to that third party who facilitates the 1031 exchange, and then they facilitate to the title and escrow company with the new purchase. It was very restrictive, and that was just a 1-inch deep explanation of the 1031 exchange. There are other options where following in a similar manner as the 1031 exchange, but the person can invest in real estate that's already being managed and having cash flow, but they don't have to have the headaches of being a landlord. Another option would be investing in a development project. So there are certain areas around the United States that the government has designated as areas that they will give preferential tax treatment to encourage developers to develop that area. And so people can invest in those areas, and that can allow them to defer the tax. And after a certain amount of time, after 10 years, the gains that they receive can actually be tax-free. One benefit of that particular strategy is not all of the money has to be invested. So with the 1031 option, let's say I received $400,000 in the sale of the transaction, but only maybe 100,000 of it was a gain. Well, in the 1031 option, all $400,000 has to go into that new investment. With the other option where I'm investing in a development project, I can do 400,000 if I want. I can do 100,000 if I want. So there's more flexibility to it. If I only want to put the gain in, I can put the gain in. And another option is a charitable strategy. Now there are many versions of the charitable strategy. So to just kind of give a quick idea of what can be accomplished. So this is another option when I've already done the transaction. So I've already sold the stock, I've already sold the investment property, I already have the money. Most people think, well, that's it. It's too late. I missed my opportunity to defer the tax, so I'll just pay the capital gains tax. But there are options in the charitable strategy where I can still have some tax advantages. And so in certain situations, some of the capital gains can be reduced and eliminated. And then since I'm making a charitable deduction, then I can help decrease my adjusted gross income. And additionally, if the amount of money that I'm donating, so only a certain percentage of my donation can go against my adjusted gross income. So let's say I donated $100,000, but maybe I can only claim 20,000 of that to reduce my adjusted gross income. But what's the nice benefit is next year I can also claim 20,000, and the year after that I can claim 20,000, and I can do that for 5 years or until that donation amount that I made is exhausted. And so that's just kind of one example of what can be done in a charitable strategy. So I can reduce the impact of the capital gain. I can reduce my adjusted gross income, and that can potentially be carried forward over multiple tax years. And so for most people, when they make a charitable donation, that's the end of it, that I donate the money to the charity, I get the tax deduction, that's the end. With these charitable strategies that I'm speaking about today, I can actually turn my donation into an income stream for myself and or my beneficiaries. And I can start that income stream today, or I can delay it for 5 years, 10 years, 20 years, whatever makes sense for my overall financial plan. So educate yourself about your options. Speak to a competent tax professional. Get out there and realize that there are more ways than one than just, well, I sold it, I have a capital gain, there's nothing I can do, I just pay the taxes. That's not true. There are multiple options. I'm just kind of scratching the surface today because it's going to depend on the person's net worth, your overall financial plan, what is available for you personally. It may not be available for someone else. So if any of this is piquing your interest, schedule your time, a complimentary session with me. My calendar link will be in the description below, and I'll do a complimentary session with you to review your situation, share with you what your options are, and see how I might be able to help. Troy Thompson, the Angel of Freedom.